What the most tax efficient thing you could leave your kids isn't money at all. Most families I work with are sitting on a ticking tax time bomb, and they don't even know it. My name is Greg DuPont. I'm an estate planning attorney, a certified financial planner, and the founder of DuPont Law Group. On this channel, my mission is to make your longevity a blessing and not a curse. In the next few minutes, I'm going to show you exactly how charitable giving, done the right way, can actually protect more of your wealth for your family. If you find this kind of integrated planning useful, go ahead and subscribe. We put out content like this every week. I hear this all the time. Hey, Greg, we're not worried about estate taxes. We're nowhere near the exemption. And you know what? You're probably right, at least on the federal level. In 2026, the federal estate and gift tax exemption sits at $15 million per person, which means a married couple can pass roughly $30 million to their heirs without owing a single dollar of federal estate tax. So for most families watching this, the federal estate tax is simply not your problem. But here's what the $15 million exemption does not protect you from: income tax. And this is where the real damage happens. Because when your kids inherit a traditional IRA, every dollar they pull out is taxed as ordinary income at their marginal rate as affected by that income. No step up in basis, no capital gains rates, ordinary income. And under the Secure Act's 10-year rule, most non-spouse beneficiaries have to drain that account completely within a decade. That means if your son or daughter is in their peak earning years when you die, they could be stacking IRA distributions right on top of their salary, pushing them into the highest tax brackets that you never intended for them. So let's peel back the layers of that onion with a real number. Imagine a couple, I'll call John and Jane. They have $500,000 traditional IRA. That feels great, right? They saved, they were disciplined, they did everything right. They pass away, and their adult daughter inherits that IRA. And she's in a 35% bracket. She has to distribute the full balance over 10 years. She could lose somewhere between $150,000 and $185,000 of that $500,000 to income taxes. That leads me directly to the insight that changes the planning conversation for lots of families. Traditional IRAs are the worst assets you can leave to your children. They're the best assets you can leave to a charity. 501c3 charity pays zero income tax on IRA distributions it receives as a beneficiary. Zero. The charity takes full value, every dollar, tax-free. Your adult children, on the other hand, pay ordinary income tax on every dollar they pull out. So the strategic move becomes clear. Leave your tax advantage assets, the stepped-up brokerage accounts, the real estate, the Roth IRAs, to your kids. And leave the traditional IRA dollars, the fully taxable retirement accounts, to charity. You're not giving away wealth. You're routing each dollar to the entity that keeps the most of it. I've built this kind of strategy into the 4D estate plan framework we use at the DuPont Law Group. Determine your situation, document your intentions, defend those intentions legally, and deliver the outcome to the right people in the right organizations. When you align the right assets with the right beneficiaries, you're delivering far more net value to your family than a disorganized estate that just splits everything equally between the kids and the government. That doesn't have to happen. And it won't if you plan intentionally. Quick question before we keep going. Does your current estate plan actually specify which assets go to which beneficiaries? Or does it account for the income tax treatment of your IRA at all? If you're not sure, send me a message. That's exactly the kind of detail we help families sort out. So far we talked about what happens at death. Let's talk about what you can do while you're alive. Because the Qualified Charitable Distribution, or QCD, is one of the most powerful and most underused tools I see sitting on the table for retirees. If you're 70 and a half or older, the IRS allows you to transfer money directly from your IRA to a qualified charity, and that transfer is excluded from your taxable income entirely. Not a deduction, excluded. You never report it as income at all. In 2026, you can use up to $111,000 per person per year as a QCD. And if you're married and both spouses have their own IRAs, that's $222,000 in charitable transfers that never touch your adjusted gross income. And the ripple effect of that lower adjusted gross income is something most people underestimate. Lower adjusted gross income means lower Medicaid IRMA surcharges 2 years down the road. Lower adjusted gross income means less of your Social Security benefit gets taxed. Lower adjusted gross income means you may avoid the 3.8% net investment income tax on your investment returns. You're not just giving to charity, you're engineering the tax situation from the top of the income statement. That's integrated planning. That's what the fragmented, siloed model of one advisor for investments, one attorney for the will, one accountant for the taxes never delivers because nobody is looking at the whole picture. Now I want to talk about a tool that takes this strategy further, specifically for families who are holding concentrated positions, appreciated real estates, or large taxable accounts. The Charitable Remainder Trust, or CRT, is a structure that allows you to transfer those appreciated assets into an irrevocable trust, avoid the immediate capital gains tax you owe on a sale, receive an income stream for yourself or your spouse for life, and have the remainder passed to charity when the trust terminates. Let me give you a picture of what this looks like. Picture a retired business owner, I'll call David. David is 68 and owns $800,000 worth of stock he bought decades ago at a very low cost. If he sells it outright, he faces a substantial capital gains bill right away. Instead, David contributes those shares to a charitable remainder trust. The charitable remainder trust sells the stock inside the trust with no immediate capital gains tax owed. It reinvests the full proceeds, and it pays David an income stream over his lifetime. He also receives an immediate charitable tax deduction based on the present value of what will eventually pass to the charity. And when David passes, the remainder goes to the cause he cares about the most. David's kids, meanwhile, inherit the other assets, the ones with a step up in basis that they can sell with little or no capital gains tax. He didn't give his estate away to the government. He reorganized it so that every dollar ended up in the hands of the entity best positioned to keep it. That's the cascading effect of integrated planning done right. For IRA owners who are 70 and a half or older, there's also a one-time election under Secure Act 2.0 that allows you to send up to $55,000 as a QCD directly into a charitable remainder trust or a charitable gift annuity. That amount is still excluded from your income as a QCD, and it creates an income stream back to you from the trust. It's a powerful hybrid for the right situation. So here's what we covered. Your traditional IRA is a tax bond for your children, but a perfect gift to a charity that pays no income tax on it. Qualified charitable distributions let retirees over 70 and a half give up to $111,000 per year directly from their IRA, excluded from income, while satisfying RMDs. And a charitable remainder trust lets families with appreciated assets avoid immediate capital gains, receive income, and still leave a legacy. This is integrated legal, tax, and financial planning working together, not in silos, and is exactly what most families are missing. If you're ready to look at whether any of these strategies belong in your plan, we welcome the opportunity to meet with you and to be of service. Go to DuPontEstatelaw.com or give us a call at 614-408-0529.